Hi everybody, it's Tuesday, October 14th, 2025. Our episode starts with our headline, Yield Curve Drops Stock Rotation to Small Caps and Defensive Stocks. The S&P 500 today went basically sideways. By the end of the day, dropping only a little bit. Earlier in the day, we were fighting our way at the bottom of Friday's giant red candle. If you caught my post in the morning, I wrote this on a little post on YouTube talking about how if we close below this Friday's candle that we could easily see much further downside. We didn't get that today. It's probably still coming, I think. We'll talk about that more in a little bit. FinViz has a great way of seeing the sector performances of the day, of the week, etc. And the one-day performance, we saw consumer defensive actually go up by 1.9% and technology drop by 1.4%. So we saw rotation into consumer defensive and utilities, finding an all-time high today. Also rotating a bit into small caps. Believe it or not, you might not hear this on other people's show. We did get an all-time high in the Russell 2000 today. Does the Russell 2000 deserve a higher price? I mean, after all, we're at the same highs that we were at basically all the way back in November of 2024. While it's not as overvalued as the S&P 500, actually let's start with that chart. S&P 500 PE ratio, very high for historical standards, especially when you take the average 10-year earnings with the Shiller PE ratio. It's extremely expensive. So while we're not in that territory, we are at the upper end of the typical PE ratio of the IWM itself. You can see we typically, it looks like we've never gotten above 19.5, according to this chart by worldperatio.com. I'm sorry you can't see the date. It goes back. This chart goes back to 1985. So in terms of catching up to the overvaluation of a lot of the other stock market, maybe it has legs to go the upside, but still, by historical standards, definitely not undervalued. And being at the upper range, again, it's all saying that, yeah, maybe this really is a top here in the stocks in general right now. Second headline of the day, fear gauges are high, VIX rises. The VIX measures the S&P 500 volatility through the pricing of options contracts. It notably rose today by 9% from yesterday's close around 19 to 20.80 today, with the S&P 500 essentially going flat and with a green candle. People might take this as bullish, but the VIX is saying watch out. The volatility is not over yet. Alongside the VVIX, VVIX, also rising today in sort of a rising uncertainty zone. We're not in panic mode yet in the VVIX. We could get there as easily as tomorrow, but we'll see. One question that we could ask is, can we hold out until we get the CPI data on Friday? Another fear gauge is the CNN, their famous fear and greed index. We are now in fear mode, actually dropping further into fear mode from yesterday's 33 reading to today's 30 reading. There are more charts that I will discuss in a moment. Before we get there, community topics. Do you have an exit plan for stocks? If so, when would you sell? Comment your methodology of exiting stocks below. Or are you going to carry them to the grave? Coming up Friday, we have CPI released because, again, they need it for the Social Security payments. We still have economic data in limbo. The federal government is still shut down due to disagreements about how to spend money, so we still don't get those initial continued jobless claims reports nor unemployment reports. And as always, we have tariff updates. We did have one update today with Powell talking. The main effect I think he had was the Fed funds started pricing in slightly more dovishness. And this is alongside, by the way, the 10-year note yield dropping. We'll get there in a second when we go through the charts. before we get there, thank you for watching, liking, subscribing. The subscription button is right over here. You just put your mouse over it and click subscribe. Commenting and supporting Robschild. No changes to the crystal ball ratings. And see my website, link in the description to read through my daily reminders, macro views, portfolio explained, and stock research center. Back to charts, starting with back to the S&P 500. Like I said earlier, we did explore the bottom of that range of Friday's candle. If we had even dipped below it, I have a feeling that that may have been a back-breaking moment for the stock market, but we recovered, and so we are in a little bit of limbo here right now. I can't discount the possibility at this point of going back up, maybe to test this previous yellow trend line that we had here going on, or maybe even get to the upper part, maybe to an all-time high, actually, within this broadening wedge at the top here. But more likely in my book, I think we're headed down. This consolidation of Monday and Tuesday's candles, it's in the bottom 50% of Friday's red candle, and so this could even maybe count as a bear flag. Again, like the beginning of the show, I think most of today's market action was sort of just rotation. Bitcoin was more bearish today as of the recording of this episode, and we also, for the fourth time in the past 5 days, have been really slamming on this 110 support level. I'm guessing and betting that it's going to head lower. And speaking of things that are hammering to go lower, we did reach intraday in the 10-year Treasury note yield just below 4%, very interestingly. Also, the 2-year sort of hammering on this level, 3.47%. I do find it notable that the 2-year dropped today along with the 10-year. It sort of says that when Powell spoke today, he was dovish enough to let the 2-year want to go lower, and the market doesn't see that as inappropriate. In fact, again, whenever the 10-year is dropping, it's saying to the Fed, we're actually not seeing enough cuts coming. But with that said, the 10-year minus 2-year, which compares the yields directly, we're not breaking lower yet. If we do break lower in this, then that is signaling to the Federal Reserve you are actually you're still restricting the economy. And the forward-looking cuts don't appear to be enough, like my crystal ball rating has been saying. And I'm kind of expecting this at this point. I think that may be the direction we're going. Like I'm saying, my crystal ball ratings have consistently been saying the Fed is not going to cut fast enough to save the economy. We'll know if that's happening in this chart, 10-year minus 2-year. And it's already sort of happening again in the 10-year minus 3-month, only looking at 3 months, as it's the spread's only 3 basis points again. Whenever the 10-year minus 3-month is inverted below 0, it's signaling, hey, the Fed is currently acting as a restriction of the economy. Neutral is not when this is at 0. Neutral is when the 10-year is yielding more than the 3-month because it has more time, and so you expect a higher yield. Next, the dollar is still consolidating in what looks to me like a bull flag after this inverse head and shoulders. Crude oil also caught my eye today, finding an intraday low we haven't seen since May, and before then 2021. Dr. Copper with a PhD in economics also caught my eye today because what a wild ride. On Friday, Dr. Copper was saying, everything's falling apart pretty clearly. And then Monday recovered all of it, the entire candle. And today we gave up all of Monday's action. So if Dr. Copper is confused about what's going to be happening moving forward, I guess so should I. Obligatory mention of gold, of course, finding a new all-time high today. Nvidia, the king of the stock market, we went down by 4.4% today. Normally, when you have this much market cap change, in dollar terms with such a ginormous multi-trillion-dollar company, it'd be a big deal. But this is what happens at the end of bubbles. This is like, peak bubble kind of action. One way to sort of look at this in a Benjamin Graham-sian way is imagine there is no stock market, but companies have values to them. One day you have a company that's worth 9 trillion, the next day it's worth 8 trillion, the next day it's worth 12 trillion. Wild times. But the other point with this chart that just caught my eye is that we're closing below. In this stock, we did have a close below Friday's bearish candle. I'm sort of wondering if this could end up leading the whole market lower. It would make sense. There's a lot of growth priced into this company, and it has a lot of market cap. A lot of people have a lot of wealth, perceived wealth anyway, in this company. It could be scary to see what happens when that starts getting stripped away. Next chart, I want to bring up junk bond credit spreads. Remember, when credit spreads are spreading, strips the legs out of the market. This is another sign that, okay, things are kind of falling apart. Granted, this went down a little bit today. This updates for the previous day for credit spreads. But it is interesting. Monday got all the way up to 3.18, a level we haven't seen since June. And, it's off the charts. They don't even have the blue line here. Look at this. I get really annoyed when these charts are broken from the Fred. But I digress. One contrarian indicator, once again, with potential volatility happening here, potential crash, potential top in the stock market, it's like very interesting that the put to call ratio is relatively low, historically speaking. There's not a ton of people that have a ton of puts right now. Again, this can allow institutions to sell the market down and not lose a lot of money. When everyone has puts and they make money on those puts from the stock market falling, they have an incentive to sort of keep the market floating. I don't see the incentive here in the options markets. So I said it last week, I think Thursday before Friday's crash, the top is in. You can see that in my videos. I still think it's true. I think the top is in, but hey, I'm just a guy with a crystal ball. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Robschild.